we are now going to take a look at learning objective number 2, and this is the forms of business organizations. So there's 3 possible forms that a business can start. That the business can be set up as. The first is a sole proprietorship. Second, we have partnerships, and third is corporations. This slide is a nice summary. I know it's a lot of information. We'll go through column by column, but it's a really nice slide to have to be able to compare each of the different sections under the 3 forms of business. So we'll start here with sole proprietorships. And the reason that they're called often a sole proprietorship is because there is only one owner. So one individual decides to start up a business, they become a proprietor. The life of a proprietorship is limited by the owner's choice or by the death of that owner. So since there's only one person, if they decide the business is over or if they pass on, that proprietorship will end. For the legal status, the owner and the business are not legally separate under a sole proprietorship. So this is really important. There's no legal documents that need to be filed, no change in legal status. They are not legally separate. But I want to note here, even though they are not legally separate, a sole proprietor would need to keep separate their accounting records for the business and personal. So you would not record any personal transactions in the business. You would keep those records separate. But for legal, they're not separate. Under a sole proprietorship, the owner is personally liable for any business debts that happen. And what this means, because we're keeping the business and personal separate in the accounting records, the business itself would take on debts. So if it purchased on account from a supplier, if the business had a loan, this would be in the business. However, if the business does not do well enough and doesn't make enough money and they can't pay those debts, the owner now has personal liability. So that means they may have to sell personal assets, such as sell their house, to get the cash to pay for these business debts. So there is personal risk related when it comes to a sole proprietorship. For tax purposes, the owner in a proprietorship pays tax on the personal tax return. So there is a statement in a personal tax return for business income, and the sole proprietor would fill that out, and that income would go right into their personal tax return. There's not a separate return that needs to be filed. An example of a proprietorship, these are typically just kind of smaller businesses. Maybe you could think of it as a side gig that someone has. So for example, if someone sells Tupperware, they typically are doing this on the side. It may be their main form of income, it may not be, but it's just a small operation for them, and they likely operate as a sole proprietorship. So they would be recording any income or expenses from selling that Tupperware on their personal tax return. Another example, right now in these times with COVID, a lot of people had started making and selling masks. So that would likely be done through a sole proprietorship and just done on their personal tax return. Okay, next we will look at partnerships. So partnerships are made up of 2 or more owners called the partners. Like a sole proprietorship, the life of the organization is limited by the owner's choices or if one of the partners does pass away. So while that specific partnership would end if one of them decides to leave or one passes away, it doesn't mean the other partner has to stop operating. They would just close the accounting records when one of the partners chose to leave and new records would be started. So the life of each particular partnership is limited by the owner's choice or the death of one of the partners. The legal status, again, like a sole proprietorship, they are not legally separate. So the partners and the partnership are looked at as one. They are not legally separate. And again, because of this, partners are personally liable for any business debts. So partnerships and sole proprietorships really are very similar. The difference is just that in a partnership, there's more than one person as part of that business. Otherwise, they have the same characteristics. So for tax purposes, again, these are on the personal tax return. So each partner, they would go through, do the accounting or the bookkeeping, create statements, and each partner would take their share of the partnership earnings. There would be a partnership agreement where it was written out how they would separate or how they would split those earnings, and then each partner would take their share and report their own portion on their personal tax return. An example of a partnership, we can kind of look at what we talked about in sole proprietorship. So the mask making. Well, maybe I decide I'm really good at making masks, but I'm not good at selling them. So I'm not good on social media and having that technology and finding people to buy them. So I might start a partnership with a friend of mine who is really good at the selling. So I would make the masks, my friend would be the seller, and we would work together in this partnership to do that. Another example is dentists, perhaps. So they may decide they want to form a partnership so that they can split costs. So you really can have multiple dentists in one location. So they could go together to split rent, split the cost of a receptionist, things like that. So now there's more than one of them, but they are operating that business together. Now, lastly, we will talk about corporations. So this is the one that really differs from sole proprietorship and partnership. The owners of a corporation, there can be one or many, so either, and they are called the shareholders. So for a corporation, as we see down here, I'll skip down to the legal status. Corporations are legally separate from their shareholders. So in order to incorporate a business, you actually go to registries, you file incorporation documents, which are legal documents, and you start up that corporation. So it is legally separate. And to become an owner of a company or of a corporation, you need to buy what is called a share. And that is just a certificate of ownership. So it shows how many shares you have and your percentage of ownership. And that is why owners of corporations are called shareholders. The life of a corporation is indefinite. And this also relates to this legally separate status. So shareholders purchase shares, and that ownership can be transferred between individuals. And because of that, the life of the organization is not directly linked to one particular shareholder, as they are legally separate. So, for example, if I were to buy and hold shares in Apple, if I decide I don't want to be a shareholder anymore, I can sell those shares to someone else or sell them back to Apple. But Apple still continues to exist. So shareholders of a company or of a corporation, they're able to change, and it does not impact that corporation, the business itself. If we look at liability for business debts, in a corporation, the shareholders are not personally liable. So if a corporation, the business is through a corporation, and it does poorly and is not able to pay off the business debts. So say you can't pay the loan back to the bank, the shareholders will never have to pay any of their personal money to pay that bank. If it ended up where the bank loan could never be paid back, the corporation would just go bankrupt, and unfortunately the bank would never get paid. So those shareholders do not have any personal liability. The only thing they would lose in a case like that is any money that they invested when they purchased shares. So they may not get that money back, but they would never have to pay additional money to cover the business debts. In terms of tax purposes, because the corporation is legally separate, there is a separate corporate tax return that needs to be paid. So this is done, and you're only reporting the income of the business in there. So you'd file this separate corporate tax return. And shareholders actually don't have any impact on the personal side unless they are paid money. So we'll talk about that in later chapters. You may know if you own any investments that you receive dividends as a shareholder, and these dividends, once they are paid, they get reported on the personal tax return. But in terms of the corporation, they file any business earnings on a corporate tax return. Now, there's a lot of corporations, so to give an example, likely any major business that you know of is going to be a corporation. So Walmart, Home Depot, companies like that, they are incorporated. But lots of smaller companies or businesses also decide to incorporate just for some of these liability reasons. It's possible for anyone to incorporate. So you may see a small bakery that's incorporated. There's sometimes, I worked in the oil field side when I was at M&P. Lots of oil field workers will incorporate their businesses as well. Okay, so let's try a little practice of these different forms of business organizations to test out what we've learned. So I know you guys can't actually answer me right now, but I suggest just pausing quickly, reading through these 5, and seeing if you're able to pick out which form of business describes each of them. So go ahead and do that. Once you've gone through, you can unpause and come back, and I will go through the answers now. Okay, so the first one, the business is not making enough money to pay its bills. The owners do not have to make up the difference with personal funds. So they do not have to make the difference, which means they have no personal liability. If we flip back here, the only time that there's no personal liability is when it's a corporation. So for this first one, the answer is a corporation. Number 2, Jack and Jill have owned their business together for 5 years. Jack dies. The business must be closed. So again, there's 2 of them, so we know it's not a sole proprietorship. And when Jack dies, the business must be closed. Well, that is a partnership. If it were a corporation, it is not, the legal life is not based on if someone passes away, it's indefinite. So this one is a partnership. And again, to note, the business must be closed, that partnership, in terms of their accounting records. So you would end the accounting records when Jack dies, and you would settle any income on your personal returns for Jack and Jill with that. But Jill can still continue to do what she was doing. She would just either start up or create this new business under a sole proprietorship, or start a new partnership if she found another partner. So outside the organization, customers may not even realize that this has happened, but on the accounting records and for tax returns, the business would be closed there. Okay, number 3, an unincorporated business with 5 owners is so unincorporated, we know it's not a corp, and if there's more than one, again, this must be a partnership. Number 4, the profits of Chi's business must be reported on her personal tax return. So here it's only telling us about one owner, so it's not a partnership. And the income must be reported on her personal tax return. So the only time you can have both of those is if it's a sole proprietorship. You could have just one owner under a corporation, but it would be reported on a corporate tax return, not personal. So this is a sole proprietorship. Number 5, there's a lawsuit against a business and there is not enough money to pay the claim. The owners only lose the amount they've invested into the business. So by saying this, the owners only lose what they've invested in the business. That means they are not personally liable. So this is like the first one. This is a corporation. The shareholders are not going to get repaid the money that they put into the company when they bought shares, but they don't have to pay extra to pay off this lawsuit. They don't have that personal liability. So that is a corporation. All right, that is forms of a business.